Hello and welcome to this video on forecasting part 2. In forecasting part 1, we learnt the 10-step forecasting process to create comprehensive financial statement forecasts, which was very practical in how to create the spreadsheet with our forecasts. In this video, our focus is going to be a little bit more theoretical and to try and unveil some tips and tricks to improve our forecasting in the future. So step 3 in the valuation process is forecasting. And forecasting is the most important part of the valuation process because once we look at the valuation models, you'll see they're just spreadsheets and everyone knows those ways of putting together spreadsheets to create the valuation estimates. It's what goes into those valuation models, the forecast numbers, that actually gives you an edge in your valuation approach. So forecasting is the most important step of the valuation process, and it's heavily reliant on what you've uncovered in your accounting analysis and financial analysis and your analysis of the business. So to be good at forecasting, you need to do a lot of research into understanding the business and understanding the firm's accounting and financial position first. History doesn't predict the future perfectly, but it gives us a good starting point on where to consider the future may go. So when we did our 10-step forecasting template, we learned that there's only 6 items that we need to forecast to be able to create comprehensive financial statement forecasts. And those 6 items that we need to forecast are the sales, the asset turnover, and the profit margin. And that allows us to then have an operating forecast. Then we looked at the firm's financing activities, we looked at the dividend payout and net borrowing cost as well to see how the firm was using their financing activities to drive return on equity. Now we're going to be looking at tips and tricks on how we can improve our forecasting, learn about how some of these items behave, and how we may consider the forecasting task. So as a refresher, here is the forecasting template. And just briefly, the items that are in red here, forecasting sales, asset turnover, profit margin, other comprehensive income, net dividend payout ratios, and net after-tax cost of debt. They're the things that you as the analyst are going to be forecasting yourself. You're guessing these numbers, you're making up these numbers, you're using a lot of research to try and think about what these are going to be in the future, but these are your forecasts. All the items in blue are going to be calculations based on the forecasts that you've just made, and they're going to make sure that our financial statements still link together nicely. So when we build a spreadsheet, we've got the items in red. These are the 6 things that we've actually forecast for our business's future. These are our expectations. And all the other numbers in black, they're just going to be calculations based on how the financial statements link together. So to try and improve our chance of being successful with forecasting, we're going to use comprehensive forecasts. That's going to be the 10-step forecasting template that we just looked at. We're going to utilize research illustrating known trends and patterns. So we're going to be using empirical archival finance and accounting research to look at how financial statements actually develop over time and what patterns are actually likely to occur. We're going to be a little bit critical and a little bit cynical. We're not going to believe everything that management say about the company. So when you read a firm's annual report, when you read their marketing material, we're going to remember that they're going to be particularly optimistic. We also have to then search for other information that may not be looking at the company in such a kind light. So we're going to be cynical. We're not going to believe everything management tell us about the business because they have strong incentives often to paint the business in a fantastic color, but we want to check that they're telling the truth. We're not going to believe everything analysts say because, again, analysts are shown to be too optimistic. We're going to read what the analysts have to say, but we're going to think about it and see if we can come up with the same thought processes and come up with the same conclusions as they do, or will we uncover information that they have ignored that may not be as much good news. And to make sure we're always thinking critically, whatever we're doing, we're always going to think about things from the bull versus bear case. We're going to take good optimistic scenario and the negative scenario and think about what could go right for the company and what could go wrong for the company. All these little steps will help improve our forecasting. We'll still make mistakes, that's okay, but it'll help us improve the process along the way. So the 10-step forecasting template we looked at creates comprehensive financial statement forecasts. It means that we've got forecasts that are consistent for our profit and loss statement, balance sheet, and free cash flows, and it makes sure that everything's balancing. It prevents inconsistent assumptions from being made. So for example, this is really common when you look at analyst reports. They might be valuing the company using something like a dividend discount model, and they might attempt to only forecast dividends into the future. But as a company pays dividends, that is also going to have an effect on other aspects of the business, such as how much free cash flow they have to pay off their debt, how much they may have used to expand their asset base and things like that. So all these things are interrelated. So if you just try and forecast dividends without trying to also forecast the firm's profits, asset growth, payments to debt holders, then you might make some inconsistent assumptions about the business. You might have dividend assumptions, payout assumptions that change the leverage of the firm that would make it look unrealistic or improbable to actually occur in the future. So we want to have our comprehensive forecast to try and make sure our assumptions are as consistent as possible. So one of the most common mistakes that analysts make is that they're too optimistic about sales growth assumptions. We always want to remember that just because a firm has been successful in the past doesn't mean they'll maintain that high level of success in the future, especially if there's industry competition. So this figure, our sales growth for US firms, if you're in the top 20% of sales growth, within about 3 to 5 years, you'll probably be somewhere back towards the middle of the pack. Now, there are some firms that disobey this rule. Apple have been fantastic for many years in having huge sales growth. But for most successful companies, they're able to maintain their high sales growth for a few years, and then they either saturate the market or their competitors catch up with them and start taking market share. So we don't want to be overly optimistic. Just because sales have been really successful for a few years in a row, we can kind of expect that sales growth may revert to the mean. It might come back to the pack. So let's not be overly optimistic based on prior successful sales growth. If our business isn't doing so well, let's not think they're going to be horrible forever. Another really common mistake is that when businesses are not performing successfully, people assume that this bad performance will go on forever. But what will actually happen is new managers will come in, there'll be new owners take over, they'll reevaluate the business strategy, they'll change things up because they're not performing well and try and get back to a profitable level. So firms that are not doing so well, they'll often change things around and get back to the mean. Not every time. There's definitely companies that fail. There's definitely companies that are unable to change their models and continue decreasing their sales over time. There are firms that have negative sales growth because their products are out of date. They're operating in industries that are just no longer relevant. So we need to do our industry and strategy analysis to make sure that's not the case. But if we're still in a successful industry, we've still got products that people generally like, but maybe we're just being beaten by our competitors in the last few years, then maybe we'll fix things up and we could expect some sort of mean reversion there. So mean reversion is a very powerful thing to remember. We need to display critical thinking. We can't just listen to what the experts say and believe them. And I really recommend this podcast, Masters in Business, the interview with Professor Philip Tetlock, who is an expert researcher in forecasting and what makes people successful at forecasting. And one of the really interesting things in this podcast is that they talk about how most people who are on TV making predictions, making forecasts, whether it's political or economics based, they're often wrong. But no one keeps track of how successful people are at forecasting. So you could go on TV every year and make a prediction about what's going to happen in the economy in the following year. And you could be wrong every year, but no one really keeps track of your predictions. So you've got no incentive to improve. And the people who are good at it don't necessarily get more credibility than the people who are bad at it. So all these people we see making expert predictions in the media often are not actually very good at it. And Professor Tetlock's research actually uncovers ways that you can improve your forecasting. And we need to know that managers and analysts display these same biases, and they actually have incentives to be overly optimistic. So don't just believe them because you think they know what they're talking about and they're close to the business and they should know. They might still be making some really common mistakes. They may be overly optimistic. So we need to dial back our optimism when we're looking at the data. We need to be a bit more neutral or maybe even conservative accountants. I've linked a YouTube video here, which is Lies, Damned Lies and Stock Market Valuations by Nucleus Investment Insights. These guys are fantastic fund managers. They were really great at predicting the coronavirus issues and probably one of the top performing funds in Australia in 2020. And in this little chart here, which I've taken from the YouTube video, what it's trying to show is each of these colored lines represents estimations of annual growth forecasts, earnings annual growth forecasts made by analysts. So analyst consensus estimates means there's going to be lots of different analysts for some big companies like Apple and Facebook and Google. And we might have 100 analysts following these companies and they've got their earnings predictions. Apple are going to grow earnings by 15%. And these databases like IBIS, they keep all these analyst forecasts. And so for each of these different colored lines, it's a different year. So in 2011, the analysts were predicting sales growth of about 22% on average. And then over time, they realized they were too optimistic, and then it ended up being somewhere about 15%. And then in 2012, they thought it was going to be about 15%, and they were too optimistic, and it trended down. And every year, we can see they were too optimistic at the start, and then as more information was uncovered, the actual growth was much lower. There was one year where that went in the opposite direction, which was 2018, where they're always estimating between 10 and 15% average growth. And then as the year goes on, they realize they're wrong and they change up. 2018 was the only one where they were actually able to increase their estimated growth. Every other time they started the year too optimistic, and they weren't able to predict the bad times and the things that might go wrong for businesses. Okay, so this is over hundreds of analysts, over the top S&P 500 companies over many, many years. And we can see the common pattern. Analysts are too optimistic with their forecasting. They always think sales growth is going to be higher than it is. They always think profitability is going to be higher than it actually is. Here's an analyst report that I like because it tries to display both sides of an argument. Normally, analysts are trying to sell you a story. You should buy this company, it's fantastic, or steer clear of this company, it's got problems. But this analyst report actually says the bull market story, the bear market story, and it tries to weigh up the good side of the business and the bad side of the business. And that's a really important thing to do in your forecasting because it shows you're considering a balanced approach and you're taking into account information from different sources. The management of the company are not going to be telling you this information. They're not going to be saying that Dr. Pepper is operating in a declining carbonated soft drink and that Walmart is their biggest customer and Walmart might have too much pricing power over them and won't be able to give them much ability to leverage their brand for pricing. Management aren't going to be admitting to these things. Management will be telling you about how they've got the best-in-class inventory turnover and operating profitability that surpasses Pepsi. Use a balanced source of information, the good and the bad, before you make your forecasts. And this is my favorite case of the last couple of years. Tesla, I think they're the most interesting company in the world at the moment, both from the products and innovation that they're creating, as well as from financial analysts. Tesla were the most short-sold company in the world, which means that people are investing their money and they'll make money when Tesla's share price goes down. So a lot of people were betting on Tesla failing. And a couple of years ago, their founder, Elon Musk, he actually did say that they were pretty close to going bankrupt at one point in time. They were really struggling with producing their new Tesla Model 3, and they had difficulties. And the financial analysis of the company at the time did show they had a lot of difficulties, and there was some legitimate concerns that this company might go bankrupt. And the accounting analysis, there was people uncovering some strange accounting choices that Tesla were making. So there was a big community of people that thought Tesla were going to go bankrupt, and maybe their accounting could even be fraudulent. That's what some people were claiming. And so they were one of the most short-sold companies in the world. However, Tesla have still been able to innovate. They've been able to create fantastic products and grow their market, and they're in an interesting market, develop all sorts of new technology that their competitors can't compete with. So now Tesla are worth about $500 billion, and the people who were short selling Tesla have lost hundreds and hundreds of millions, maybe even billions of dollars over the last couple of years. The people who loved Tesla really loved it, and they were saying this is going to be the biggest company in the world. The people who hated Tesla said, this company's going bankrupt. It was very rare to hear people's balanced opinions in the middle. There was really strong cases either side. The key thing there is if you're thinking about investing in a company like that, you've got to listen to both sides of the story. You've got to make sure you're thinking about, okay, what is true from the people who think this company is horrible? What is true from about the company from the people that think it's going to be the biggest, best company in the world? And where are they overly optimistic? Where are they overly pessimistic? And can you try and be balanced and somewhere in the middle there? I've mentioned Professor Tetlock a few times already, but here's a nice article, 10 Commandments for Super Forecasting. Have a look at that, see what 10 rules that you can follow to try and improve your forecasting when you approach the forecasting task as well. So the next thing to do, when we're forecasting, we know we're going to make mistakes, so we need to do a sensitivity analysis. Really straightforward, we need to think about what happens if things go better than expected. That's our optimistic scenario. What happens if things go worse than expected? Our pessimistic scenario. And what is the case where we most likely expect to occur? That is our most likely scenario. So we're going to do forecasting. We're going to change some of our assumptions based on things happening. And when you do a sensitivity analysis, don't just say, oh, I'm going to increase sales growth by 2% or down by 2%. Think about what changes in the actual business, the environment, the economy will lead to these changes. Don't just say, oh, the profit margin could be 6% instead of 4%. think about what the managers of the business would do, what would be happening in the industry or the market for the profit margin to be able to increase to 6%. Are they going on a cost-cutting strategy? Are they able to innovate their manufacturing processes to reduce waste and lower their costs? What are they doing? What are they trying to do to improve their profit margins? Okay. Likewise for the pessimistic. Don't just say, oh, imagine the turnover dropped by 50%. What would cause that? Are they going to have mergers or acquisitions? Are they going to spin off part of their business? Is the industry changing? Have they launched new products? Have they launched new stores? What's happening in the business to lead to these potential changes? Do your sensitivity analysis based on what you think may or may not happen. When you do your sensitivity analysis, you want to do it for the 6 things that you have to forecast and the cost of capital. You want to consider historical patterns of performance. So if you're forecasting that for some reason that firm's going to really change from what they used to look like, maybe they've had a merger, they've launched new products, entered into a new market, they're now selling into America when previously they didn't. If you've got any of these changes forecast, then you might think, what about if that doesn't happen? Okay, or what if things go back to the historical averages? That could be a way of testing your sensitivity. If you think the industry is really changing, or if you think maybe there's this big change just around the corner, a technological innovation, what happens if that doesn't occur? Okay. All these things can be put into your sensitivity analysis. Then as you change these in your forecast, it'll change your valuation estimations as well. So the key thing for your sensitivity analysis, tell a business story that would lead to the numbers changing. Don't just change the numbers in the spreadsheet. Think about real world decisions that people are making to lead to these numbers. What's the story behind them? What does sensitivity testing look like? Well, you can set it up something like this. You can have your different assumptions that you're making. You can discuss an optimistic case, what the share price would be, and a pessimistic case, just changing one thing at a time. And in these cases, you would have to explain what is driving the optimistic or pessimistic scenario there. Okay, then you get these different share prices. Then on balance, you can look at the expected share price that you've got versus the different share prices based on the changes in these items. And then from there, you'll also see what the business is really sensitive to. Which of these numbers changing will lead to biggest changes in the share price? Because that's important to know as well, what is really driving your firm's share price? Because that's what management are going to be most commonly looking at, the things that they're really sensitive to and trying to change that for the better. So you need to think about your forecasting methods. Obviously, historical averages are a fantastic starting point. You need to know what's happened in the past before you can try and predict the future. But the past does not always predict the future. Okay, so when you are looking at your historical averages, you need to think about how you're looking at it. Are you looking at levels or changes? So for example, this is Apple's annual sales. If you just take an average of their sales, okay, it's along here, and you'd see for the later years, 2014, 15, and 16, you'd be quite far off because Apple have had consistent growth. If you estimated their percentage change every year and took an average of their percentage change, your estimations would be much closer. Okay, so sometimes we might be able to take an average level over time. Other times we might have to take an average of the rate of change, the percentage changes. Different ways of doing it may be more or less accurate. So we need to look at which is going to be more appropriate as a starting point for it. Doesn't necessarily reflect future performance. If in 2017 Apple decide to drop one of their products or they create a new innovative product, that's going to lead to changes that may fluctuate significantly from this simple. You can get much more statistically advanced as well. Okay, that's outside of the focus of this course, but there's obviously statistical methods such as regressions that are really common. And now with data science, we've got all sorts of neural networks you can build using past data to try and predict the future. We're getting some pretty good results with being able to improve our forecasting and being able to predict things better based on historical information with some of these statistical methods. So if you understand regressions, feel free to use them to try and improve your forecasting. If you understand any of the more advanced computer science methodologies, then please feel free to use them, but it's not the focus of this course. When we're looking at financial statement data, seasonality could be really important. In America, reports are released quarterly. In Australia, every 6 months. So in Australia, the 6 monthly reports, you might have a busy period and a quiet period. You might have seasonality in your data like this for Apple, where you have busy part of the year and down parts of the year. Okay, so when you're doing your forecasting, for example, if you've got a half-year financial statement that's been released, you need to know, is the first half of the year a better part of the year normally, or is it the quieter part of the year? Because that information may help you make a more accurate end of year revenue or profitability estimate as well. So make sure you check for seasonality in your business. And then when you look at the interim financial statements, if you understand the seasonality, you'll get a much better or much more useful information from your half yearly statements there. So financial analysts are really important in analyzing company information. And broadly, there's 3 types of financial analysts. Sell-side analysts are the ones that get the most media attention. They typically work for the investment banks, the stockbroking firms, and they're going to be issuing stock recommendations on the securities they cover. Then you've got buy-side. They typically work for people that are actually investing the money, so mutual funds, and they create research that they keep in-house, private research that the fund then invests based on. And then there are independent analysts, and they sell independent research reports on a subscription basis. They're going to emphasize that they're independent, there's no conflict of interest, and so they will claim that their research is better because of the independence. So sell-side analysts, as I said, they're the ones that get the most media attention. You're working for Goldman Sachs, JP Morgan, and you're releasing research on a big company like Google or Facebook. Okay, it gets media attention if Goldman Sachs upgrade or downgrade their recommendations on a big famous company. These analysts generally follow companies in a similar industry, so you'll be a car expert or you'll be a mining company expert. And they're going to build up their models and they're going to speak to management, customers, suppliers. They're going to be getting information well outside of just the financial statements. They're going to be talking to as many people as they can to really get an understanding of the business. They'll be looking on LinkedIn to find ex-employees and current employees, and whoever they can talk to, they will. However, despite having all this fantastic information, they may have potential conflicts of interest. And this has been shown in the past, and hopefully it is less now, but there's always still the problems. Investment banks want companies to be happy with them, so that if you're Google and you see Goldman Sachs have written an analyst report that says how good Google are, then when Google want to sell more shares, they might go to Goldman Sachs for investment banking services. Okay, so the analysts may face pressure to be overly optimistic so that the companies perceive their investment bank kindly and then send investment banking business to them. Okay. So there's lots of research that has shown that sell-side analysts have these incentives to be overly optimistic, and their research reports are overly optimistic. In all the financial crises and down markets, it always comes out that certain analysts could kind of see that the company they were following might have been entering into difficulties, but they still maybe had buy recommendations for a little bit too long. On Yahoo Finance, you could have a look at companies like Qantas. It talks about the analysts that are following Qantas at any given time and their estimation on their earnings. And this information is available for large companies that have lots of analysts following them. Check it out. These are from the sell-side analysts. So remember, they might be a little bit too optimistic on average. Sell-side analysts, when they produce their reports, there will be a lot of information in there. So this is from Morningstar, going into Dr. Pepper Snapple Group, and they'll cover all sorts of information. And the assignment that you're going to be creating when you value a company in this subject, you're going to be creating something like these kind of equity analyst reports as well as part of your work. So I've been a little bit critical of financial analysts so far. And if we look at this paper from 1978, it says, in contrast with other studies, the results overwhelmingly favor the superiority of analysts over time series models. Okay, so back in 1978, there was some evidence that analysts were doing a pretty good job, and they were better than just normal time series, taking an average of prior years' profits and earnings. However, more recently, this is 2012, they find that simple random walk earnings per share forecasts are more accurate than analysts' forecasts over longer horizons. So when they say simple random walk earnings per share forecast, they're doing really simple, sort of just taking the averages and a little bit of a random number effect to it. And over long-term forecasts, these simple models are more accurate than analysts. Okay, so then they find that the naive extrapolation, so their simple model, knowing nothing about the company, just taking averages of analysts 1 year ahead, of the most accurate estimate of long-term 2 and 3 year ahead earnings. So their naive, very simple models, just using averages, are better than the analysts over these 2 and 3 year periods. Okay, so I'm being a little bit critical of analysts, saying they're overly optimistic, and some of these research papers actually provide pretty compelling evidence of this often being the case. This paper is looking at crowdsourced earnings forecasts. So one way of improving your forecasting ability is using the wisdom of crowds. And this paper, using Estimize, which is a crowdsourced earnings forecast platform, finds that crowdsourced earnings forecasts are more accurate because you're getting information from hundreds of different people who all might know little different bits that are different, and building that up together, the wisdom of crowd seems to improve forecast accuracy. So getting a range of opinions from a range of different people with different backgrounds and experience can seem to be beneficial in this case. This paper in 2007 in the Journal of Financial Economics, it finds that analysts' recommendations relative to consensus are positively associated with investment banking relationships and brokerage pressure. So again, we talked about how analysts may face pressure to be optimistic about firms. And for example, if I'm an analyst following BHP and BHP use my investment bank for mergers and acquisitions, so we've got a investment banking relationship with the company, then as an equity analyst, I may face pressure to be overly optimistic towards BHP. Okay, so that's what this paper's finding over 94 to 2000. And we know in hindsight, there was some court cases that came out that a lot of the firms in the dot-com crisis, the investment analysts were way too optimistic because they wanted to get investment banking business from these dot-com companies, which were selling a lot of shares. They were doing IPOs and they were engaging in lots of mergers and acquisitions. So this paper, the evidence really supports what stories came out in the media about how the equity analysts were behaving. Managers often release forecasts about the firm. Definitely look for these when you're doing your forecasting. Managers are going to be the experts in their business. They're going to know the most about their business, and they should have the most accurate forecasts about the future. Except they may have some incentives to be a little bit optimistic. But if you can find management forecasts, that's a great starting point to think about what your forecast should be. Management have motivation to make these voluntary disclosures to make sure investors have a good expectation of what's going to happen. Okay, so we don't want investors being too far off the mark. It could pump up the share price sometimes in the short term. And management forecasts are not systematically higher than existing analyst forecasts or actual earnings. So overall, these could be a good place to look for information. However, they may be used in certain cases in a way that may bias things. Okay, but on average, management forecasts are pretty good. You should definitely look for them, see if they're there to help you start your forecasting journey. So for example, here's Woolworths. The managers are looking at their future outlook. Regardless of if they estimate their expected profits or earnings in the future, things like how many supermarkets they're going to open, how many different stores they're going to close during the year, this information is really important because that will allow you to build up your forecast as well. So the management forecast and discussion of their plans for the future, really valuable source of information. Qantas here, we've got a media release about their expectations. They're talking about specific accounts, like their fuel cost is expected to be no more than 3.2 or 3.13 billion. Okay, so they're giving us some really good information about specific accounts, which will really help us understand and build up our profit margin forecasts in this case. So in conclusion, forecasting is difficult, and I can't teach you how to get your forecasts 100% right. If you do get your forecasts 100% right, your valuation models are going to be almost perfect, and you're going to be making lots of money on the stock market. However, it's not that easy to always get them correct. What you have to do is you have to put in a lot of work to get your research. You've got to be looking at different information sources, and you've got to be thinking about common mistakes and trying to avoid them where possible. You've got to utilize critical thinking. You've got to look at the good and the bad information. You've got to look at what managers say as well as what people who are short selling say. And you've got to really utilize your understanding of the business, your understanding of the firm's accounting and historical financial performance to help build up your forecasting. Good luck with it. Thank you very much.